Getting back into it. Okay, so legal and accounting fees. If incurred in the ordinary course of a trade or business, then it's deduction for DGI. That includes tax preparation fees for Schedule C, E, Part 1, and F. Um, just real quick segue here. Often when I'm working on a tax return, it's got a Schedule C. Um, there's often that gets mixed in with an individual's 1040 and their Schedule C. So part of that is going to be a deduction for the Schedule C, right? And so that's why we will specifically say, this is how much is a deduction for, this is how much you're paying on this invoice for your Schedule C. Here's how much you're paying for your 1040. This is a deduction for the Schedule C, but you kind of got to split it up. It's pretty similar to sales tax. You go visit any auto mechanic, they're going to split out the labor versus the parts cost. And that's because labor is not subject to sales tax, whereas the parts cost would be. But if it's all grouped together, then it's all subject to sales tax, which isn't the right answer. So people have to split it out and say, this is for this is for that. And the reason for that is because those items get treated differently. Um, in the case of the auto mechanic, it's some of this is going to be subject to sales tax, the parts, but the labor isn't. But if you group it all together, then it's all subject to sales tax. So that's why you'll often see things split out. Legal fees for purchasing property must be capitalized to its cost basis. Legal fees incurred for personal reasons are not deductible, which is fairly obvious. And settlements, legal fees associated with sexual abuse or harassment suits are not deductible. Obviously, the government is not looking to subsidize that in any way. Capitalization versus expense deductions. Certain expenses which normally would be deductible may be required to be capitalized per section 263 and must capitalize costs if it provides permanent improvement or betterment that increases the value of any property or it restores the property to its normal usage. It's repairs versus capitalization. If you repair part of your roof, that would be an expense, that'd be deduction. If you replace your roof, that's a new asset, you got to capitalize that. So you don't get the immediate deduction. You could with section 179, but it's a new asset, so you got to capitalize it per section 263. Election to capitalize deductible items. Capitalized costs are added to the property's basis. Section 266 allows the taxpayer to elect to capitalize items that normally would be deductible. Interest and taxes incurred for personal property until it is placed in service. Property taxes, interest, and carrying charges on unimproved and unproductive real estate. And finally, taxes, interest, and other expenses, development of real property. People don't often do this. Generally, if someone can take an immediate expense on something, they're going to take it. But you can capitalize certain deductible items. Expenses related to exempt income, section 265, no deductions allowed for expenses associated with exempt income. If I spend 80 hours trying to get this federal grant, and this federal grant is not, it's tax exempt, I don't also get to deduct the expenses that I took to get that tax exempt income, because then I'd be kind of double dipping. Here I've got this income that's not taxable. I can't also take deductions that I had in order to get that tax exempt income, which kind of goes into this next point, prevents the taxpayer taking a double tax benefit. Interest expense on debt used to acquire tax exempt securities is the most common situation. Expenditures contrary to public policy. No deduction payment is illegal or penalty or fine for an illegal act. Examples include illegal payments to government employees, kickbacks, rebates, bribes, and Medicare and Medicaid, payments of fines and penalties, and double damage under federal antitrust laws. So kickbacks versus rebates. Generally, illegal kickbacks, they're not deductible. A rebate is a reduction of the purchase price of an item and is a reduction of income. The rebate must be paid to the purchaser, in order to be excluded by the payroll. Expenses related to any illegal activity. While bribes, kickbacks, and fines and penalties for illegal acts are not deductible, ordinary and necessary expenses in running the business are deductible. Taxpayer must report income from illegal activity, and covered that before. However, if activity is drug dealing or trafficking, then no expenses are deductible. You can probably imagine how many people are reporting their drug dealing or trafficking on their tax return. It's probably not a lot, so expenses probably aren't going to be reported anyways, but the IRC specifically excludes drug dealing or trafficking businesses to have expenses. Lobbying and political contributions. Generally, expenses associated with lobbying or direct contact with legislators in order to influence legislation are not deductible per Section 162. There are certain exceptions to that. Influencing local legislators on matters of direct interest to the taxpayer's business is deductible. Total lobbying expenses under $2,000 are deductible, and that exception does not extend to state or federal legislators. Finally, we're getting into deductions from AGI. This gets reported onto Schedule A, otherwise itemized deductions. Certain expenditures must exceed a threshold before the expense can be deducted. Medical expenses, it's got to be more than 7.5% of your AGI before you start seeing a benefit to that. Meaning, if I had a $100,000 salary, I would need to spend $7,500 before I start seeing any potential benefit to what I'm using for that. So everything below 7,500 doesn't count. It's only what's above that 7.5%. And then casualty losses have to be greater than 10% of AGI. Certain deductions may have other limitations, charitable contributions. It's got to be less than 60% of AGI. I can't recall a time I've ever seen someone gift more than even 20% of their AGI. Property taxes up to 10,000, state taxes also up to 10,000. That's commonly referred to as the SALT limitation. SALT stands for state and local taxes, and you can only deduct up to 10,000 for that. Why are deductions for AGI versus from AGI important? Which way would you rather have a deduction, as for or a from? Although it's not as if you get to choose, just like the point. I think you guys know, but I'll tell you, it's better to have a deduction for AGI. Less limitations. From AGI, you've already got the standard deduction, so you have to clear that bar first. Whereas with for AGI, it's a lot more flexible. AGI is at the bottom of page 1 of the 1040 and will affect the allowable deduction for certain itemized deductions. Example, medical and dental expenses are limited to the amount that exceeds 7.5%. Here it goes into an example similar to what I just did. So if you have AGI of 100,000, medical expenses of 12,000, how much is deductible? Goes into that. Jeffrey is a single person, age 35, with no dependents. In 2018, Jeffrey has gross income of 65,000 from his sole proprietorship, and he incurs 66,000 of deductible business expenses in connection with proprietorship. He works part-time as a bartender earning $10,000. He has interest income of $500. Jeffrey has no itemized deductions. What is Jeffrey's taxable income? We go here. There. So he has 65,000 plus the 66 plus the 10 plus 500. His AGI, his taxable, his AGI would be. And then he would get the standard deduction since he has no itemized deductions, which is 13,500 roughly. So he's going to have taxable income of 0. There you go. Other non-deductible expenses, executive compensation greater than $1 million is not deductible. That applies to CEOs, CFOs, and the next three highest compensated officers. And business interest expense greater than business interest income plus 30% adjusted taxable income, which is not deductible for businesses with gross receipts greater than 26 million over the prior 3 years. Pretty rare you run into this. I'm not really working on returns with CEOs making over $1 million. I'm sure some people work on those returns, but I don't see this a whole lot. I think I'm going to stop this video here, and we'll continue in the next one.